This content is for educational purposes only and does not constitute financial advice. All trading involves risk. Always do your own research or consult a licensed financial advisor before making decisions. Welcome back to Forex Mastery, from zero to hero. In this episode, we unlock one of the most visual and powerful elements in the trader's toolbox: chart patterns, trend recognition, and technical indicators. By the end, you'll understand not only how price moves, but also how to recognize patterns that repeat and use technical tools to confirm your trades with confidence. Let's dive in. Price movement basics. Trends and ranges. Before we get into patterns and indicators, we need to understand the basic behavior of price. Markets don't just go up or down. They move in phases, trending or ranging. A trend is a directional movement in price over time. In an uptrend, price forms a series of higher highs and higher lows. In a downtrend, it forms lower highs and lower lows. It's like a staircase, either ascending or descending. Your job is to recognize the direction and align your trades with it. Now, what if there is no clear direction? That's a range. In a ranging market, price moves sideways between a horizontal support and resistance. Think of it like a bouncing ball in a box. Price hits the floor, bounces to the ceiling, and repeats. In this phase, traders often buy near support and sell near resistance. Recognizing if a market is trending or ranging is the first step toward choosing the right strategy. Chart patterns predictable. Market behavior. Chart patterns reflect price action and the psychology behind it: fear, greed, hesitation, and momentum. Let's cover three powerful patterns every trader should know. First, the double top and double bottom. These are classic reversal patterns. A double top appears at the end of an uptrend. Price reaches a high, pulls back, rises again to the same level, and fails to break higher. That failure signals that buyers are losing strength. The price may soon drop. A double bottom is the mirror image found after a downtrend. Price hits a low, bounces, then tests the same low again, and holds. This shows selling pressure may be exhausted, and a bullish reversal could follow. Second, the head and shoulders pattern. This is one of the most powerful reversal patterns. It starts with a peak, the left shoulder, followed by a higher peak, the head, then a lower peak, the right shoulder. The line connecting the two troughs is called the neckline. When price breaks below this neckline, it often signals a strong move down. There's also the inverse head and shoulders, which forms at the bottom of a downtrend and often leads to a bullish move. Chart patterns are not perfect predictions. They are visual clues about possible market behavior. Technical indicators. Confirming what you see. While patterns show possibility, indicators offer confirmation. They add data, structure, and signals to your analysis. Let's break down three key tools: RSI, MACD, and moving averages. First, the Relative Strength Index, or RSI. RSI measures the strength of recent price moves. It ranges from 0 to 100. Above 70 is considered overbought, a potential sign of a reversal downward. Below 30 is considered oversold, suggesting a possible reversal upward. You can use RSI to identify trend strength, entry points during pullbacks, divergence between price and momentum. For example, if price is rising but RSI is falling, that could be a sign the trend is weakening. Second, the MACD, or Moving Average Convergence Divergence. MACD uses two lines, the MACD line and the signal line. When MACD crosses above the signal line, it suggests bullish momentum. When it crosses below, it indicates bearish momentum. MACD also includes a histogram. Those vertical bars show the strength of the move. It's great for spotting early shifts in momentum and trend changes. Third, moving averages. These are simple yet powerful. A moving average smooths out price action, showing the average closing price over a specific period. Two popular types: simple moving average, SMA, Exponential, moving average, EMA. EMA gives more weight to recent prices and reacts faster. Some key levels: 50 EMA short to medium-term trend, 200 EMA long-term trend. If price is above both, you may be in a bullish trend. If it's below both, you're likely in a bearish trend. Watch for golden crosses when the 50 EMA crosses above the 200 EMA and death crosses when it crosses below. These are major trend signals. Bringing it together, strategy through confluence. How do we use all this in a real strategy? Here's the key. Confluence. That means multiple tools pointing to the same conclusion. Let's say you spot a double bottom. RSI is rising from oversold. MACD just crossed bullish. Price is holding above the 200 EMA. This setup has high confluence, multiple confirmations, and a higher probability of success. It's not guaranteed, but it's more reliable than any single tool alone. Patterns show the shape. Indicators show the strength. Trends give context. Your job is to combine them intelligently. Timeframes, know your chart's language. Everything changes depending on time frame. Patterns and indicators behave differently on a 1-minute chart compared to a 4-hour or daily chart. Shorter time frames like 1 minute or 5-minute are fast and noisy. Great for scalping but risky. Mid-time frames like 1 hour or 4-hour give balance and are great for swing traders. Daily charts offer strong trends and smooth setups perfect for position trading. Choose a time frame that fits your lifestyle, psychology, and goals. Final thoughts. Tools, not magic. Chart patterns and indicators are not magic. They are tools, and they only work if you use them with context and discipline. Every great trader knows. No pattern is 100% indicators lag. Risk management is everything. But if you master the basics, recognize patterns, and confirm with indicators, you'll begin to see the market differently. You'll stop reacting and start predicting. Up next, Episode 9. Entries, Exits, and Risk. You've got the tools. Now let's learn how to actually use them in the next episode. In Episode 9, we'll cover how to enter trades with confidence, set stop loss and take profit. Like a pro, size your trades smartly, and manage risk to protect your account. We're getting close to building your complete trading plan. I'll see you there.